Hello, my trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at inflation data here at the start of 2024 and what it could mean for the stock market, as well as interest rates and US dollar. But first, let's take a look at that US dollar and recent price action, signaling a couple of potential things that could be either a resurgence to its heights if inflation comes in high here in February, or a significant potential move lower given the recent rallying if inflation comes in under and gives cause to the U.S. central bank, the Fed, to potentially cut rates faster than expected. But you're looking at a dollar that's up over 5% year to date, and it's only not even mid-February here. Now, of course, we're looking at the dollar versus the yen, which has been, of the major 5 or 6 currencies against the dollar, one of the weakest historically in recent years, but still just an unbelievable move from below 142, where it concluded 23, to now close to 150, above 149 in recent trading. And keep in mind that 150, 151, 152, though you can see it in recent months, those are approximately 30-year highs for this dollar yen market. 30-year highs right there around the 150 to 152 range, and we're only about 100 pips away from getting in there. So dollar up. Now, what would that usually coincide for stocks in recent years would be downside, right? Oh, the dollar's rallying because inflation's in the 8, 9, 10% handle. They're hiking interest rates, and stocks with all these unknowns on the table are moving lower. Well, no, the stock market is right now trading around all-time highs. S&P's put in another new all-time high here in February, up more than 25% since the start of 2023. And seeing, it's funny, you see the last part there of 2023 and the stock market rallying so hard as dollars were moving lower and U.S. interest rates were moving lower, which we'll rope in just a second. But now here in 2024, dollars moving higher again, U.S. interest rates are moving higher again. But the stock market, they've had some of the best earnings that they've had in recent years. A bunch of the main stocks, the higher weighted stocks in the S&P. The stock market is actually doing quite well with this recent rise in U.S. dollar and U.S. rates. And they don't have to be enemies all the time, but they can be, and we'll talk about that in a second, because we have some inflation data that'll be coming out here in February that'll be essential to setting the path for the Fed in what was expected to be a string of rate cuts here in 2024. Those have started to get priced out, and part of it is owing to the fact that this inflation hasn't gotten down to 2%. And you also might ask yourself, well, the last time the stock market made new all-time highs after the pandemic bounce back that we saw in 2021, that's when inflation started moving higher. And so if there is a correlation between, U.S. stock market doing all-time highs now, U.S. economic data, the employment data that came out in January and February of this year so far were much stronger than expected, then this inflation could resurge back to, 4%, 5%, 6%, or even higher where it was in 2022, up at 8 and 9%. Of course, we don't want that, and the central bank doesn't want that. They have a long-term target of 2%, but we'll see where this inflation comes out, because it's been hanging around 3 to 4% here with headline inflation. And then when you look at the core inflation that strips out some of the energy and food prices here, has been a lot stickier, although it hasn't been bouncing around as much. That headline inflation got down to the low 3s and then bounced back to the high 3s, and now is expected to come around, I believe it is the mid 3s in there. This core inflation has been more of a smooth ride lower, but hanging around 4%. And that is not the 2% target. And especially if this stock market doing all-time highs, this some of the best employment data that we've seen, even factoring in that pandemic bounce back, the most recent non-farm number, almost twice what was expected with job growth there. This inflation could spike again, and that's where you get into iffy territory for the stock market and potentially highs again for the U.S. dollar market, because that could cause U.S. interest rates to not see those cuts as we take a look at projections for the end of this year. And the focus of this distribution, and this comes from futures prices around Fed funds rate, the focus of the distribution is right there around 4%, which would be more than a full percentage point lower than where the Fed funds rate currently is. And that's by the end of this year. So that's pricing in multiple cuts or one full 100 basis points or more cut from the Fed, however you want to slice it here. But if inflation does resurface, and they have already been pushing these cuts out in time, they could potentially price them out completely, and the Fed doesn't have to cut just because the futures market has priced it in. If inflation resurfaces here, U.S. Interest rates don't end up getting cut, or the unforeseen, or at least not priced in right now, inflation resurfaces and maybe the Fed has to raise interest rates past 5% where they're currently sitting, that could be good for that U.S. dollar theoretically, and could be bad for the stock market that's gotten definitely comfortable with high interest rates. But I would imagine that higher than where they've priced in of 4 to 5 or so percent, that could cause some downside in the stock market. We'll see where it all lands when these inflation numbers come out, but so valuable not only to the Fed and their 2% target and their potential interest rate cuts at some point this year, but especially that U.S. dollar trading and on to the stock market at large.